Peter, you say it's a mistake for the markets to concentrate on the jobless data. Why?
Because I think last Friday's non-farm payroll was good enough that the Fed has really just looked at jobs. And now I think they have to start looking at inflation. And the inflation data, it's okay, but it's not great. And you start looking, okay, if China's stimulus is successful, what happens there? Oil's coming off a little bit today, but we've got geopolitical tensions everywhere that's putting pressure on oil. And then finally, I think the hurricane rebuilding is actually going to be inflationary for the U.S. One, it's disrupted some supply chains, but you're going to have a lot of insurance checks coming in. People want to fix whatever got broken. I think we're going to see a bout of inflation coming into the fourth quarter.
If we get a bout of inflation, is this going to be one of those periods like we had to start the year to say, okay, the Fed's just going to wait and see, they're going to ignore it? Or is it so bad that, especially adding in an election, a potential Trump presidency with more tariffs, as some have claimed, maybe it's even hikes on the horizon with all those factors?
So I don't think it's hikes. I think we get 25 bips in November. I think they're kind of set on that pace, and it would almost be embarrassing for the Fed to say, we did 50, now we're doing 0. So I think they get 25, but that puts us on this pause, and it is going to be data dependent. But I do think, one of my views has been we really skew the data here because we use these 5-year moving averages to do the seasonal adjustments. We overstate jobs in January, February, March. We understate them in the summer. So it was not as good in the first quarter this year as it looked. It wasn't as bad over the summer. So I think we kind of meander through. But if the jobs data stays okay, inflation ticks up, the Fed's going to have to watch that.
It's interesting you say they're going to go 25 because it would look bad to pause. And maybe it looks like a mistake. Raphael Bostic gave an interview to the Wall Street Journal yesterday, and he said this choppiness to me is along the lines of maybe we should take a pause in November. I'm definitely open to that. Do you think this is Bostic, and maybe others will follow, trying to set the stage to say, it's just because of the choppiness of the data. We didn't make a mistake, but we should pause.
So I think they're trying to set that up, but I think that's why we get 25, right? So they've certainly talked the market out of 50, which I thought was ridiculous. Like the market thought it was going to be 50, 50, 25. So the market's been moving my direction. I think the two things that are going to happen is, one, fewer rate cuts up front. So we get 25 in November, probably a December pause. The other thing is they're starting to talk about the neutral rate. And I think the neutral rate's going to be more like 3.5%, 3.75%. Because if you look at it, right, we've been above 5% for a year and a half. The economy barely nudged down. So this thought that the neutral rate is somehow 2.875 or 3%, I think is wrong. And as they analyze this, what we're going to realize is fewer cuts next year, and the terminal rate's going to be much higher. I think it's going to be at least 3.5%. That's going to weigh on bond markets. So I think the 2 years probably okay, just around 4. I think we get back to 420, 430 on the 10s. And what's starting to make me nervous is I feel like the bond market, the liquidity is not what it once was. Everyone gets positioned one-sided, and now we're starting to move higher. I would have thought yesterday, after the 10-year auction, 30-year auction was done, we could move back towards 4% on 10s, and here we are at 409. So I think we could break much higher on 10s.
So we could break much higher. And then you've laid out all these risks on the horizon, specifically geopolitical tensions. And I know you have some of the brightest minds at Academy Securities, former generals analyzing this. What is the risk that you all see that there's a disruption in oil production and could lead to what you're talking about, that break higher?
Yeah, so we've got 20 retired generals and admirals who serve as our geopolitical intelligence group. So it's amazing that I get to work with them. And I think we're looking, and I think you're seeing it in the media, that Biden is trying to slow Israel down, but I think from a pure military standpoint, so ignoring everything we can on the humanitarian side, if you're looking at it from a military standpoint, Israel has a lot of things going in their favor. They have the proxies on the run. Iran has kind of shown itself to be a weak leader of the proxies. So we think they're going to continue to push on the proxies because they no longer trust Iran, right? They sent 180 ballistic missiles, nothing really hit anything of importance. And maybe they go after Iranian oil fields, right? That's the next thing, right? How do you stop the funding? Now that they've got the people on the run, so we think that's in play. And Russia-Ukraine's always there in the background. That's heating up. And there's a reality that maybe Putin or someone's going to want to create inflation ahead of the election. So I think oil's the way to play this. I think you want to be long at these prices still and buy oil. And I do not think treasuries are going to work as this quote-unquote flight to safety. Because what's happening right now is every time you get a geopolitical event, maybe you get a brief rush to treasuries, then people realize, oh my gosh, global spending on military is going to have to increase. Domestically, foreign, that's just going to put pressure on yields across the globe.
Not to mention the inflationary impact of higher oil prices. But, okay, so there could be oil disruption from Iran, but the big threat that everyone talks about is disruption in the Strait of Hormuz, is Iran attacking that Gulf supply. How big of a risk is that?
So I think from our military people say it's not a huge risk. They can disrupt it, but we have the tools, the ability to, sweep it out very quickly. So, but it would escalate, there'd be the fight. But I do think you're right. We are much more focused on oil transportation than the oil fields themselves, right? Damage to the oil fields tends to be fixable. It's easy. We're looking at really the transportation hubs, the ports. I think that's where the real danger lies.
And so what oil prices are we talking here? Because it's the scenario, again, where oil goes higher and then you don't get that hedge of treasuries. I find that really interesting. So how high could oil go in this scenario?
So we kind of view, and again, we've been trying to play it in this range, but once you get near 90, I think that's about it, because the Saudis will flood the market at, we believe somewhere above 90, that's where the Saudis really step in. They keep oil supply going. So again, so long as they can ship it out there, and so far that's not our base case that they won't be able to ship it. So kind of 85 to 90 is where we kind of lighten up on hedges. 75 and below is where we buy these hedges.
Peter, before we let you go, we're about to get some of the big banks reporting. You mentioned bond market liquidity, but you've been excellent on stock market liquidity too, and some of the outsized moves in single name stocks. How are we set up into this earnings season?
It feels like we're going to continue to have these outsized moves. Like, you look at earnings and like, oh, that should be 2%, and all of a sudden the stock's up or down 10%. And sometimes it's both, right? It's up 10% initially, down 10%. So I do think there's very little depth of liquidity. I think all these algos drive things. I think that's one thing that happened yesterday morning. The algos are still kind of set to trade off the jobs data. They got it a little bit wrong, and I think over the next coming days or weeks, they'll start being re-triggered to trade off the inflation data. That's when I think this pushes through, and I think people are going to be surprised that China, the initial stimulus package looked meh. They are going to continue to push this. We think the CCP, to stay in charge, needs the economy to do better. They need to buy time for their Made by China strategy to grow. They're going to want domestic consumption to work. So we're going to see more and more stimulus out of China. So probably right now, my favorite stock market own is China via FXI, probably.
So I'm guessing you're going to be watching this Saturday?
Of course.
Okay, Peter, we'll get your take after.